Dean, what impact are geopolitical issues having on the oil markets?
Well, there's clearly a premium when you're looking at, you can say glass half full or glass half empty in the way oil markets and prices. Uncertainties and the things that could affect prices concern Iran mainly. So the scenarios around that, if that escalates, that's the fork in the road that could affect global oil markets in a substantive way. But barring that, it is pretty remarkable, despite all of the uncertainties from Russia, Ukraine, what's happening with Hamas and Israel, plus Iran peripherally involved, that we only have $1 per barrel oil.
Why does Iran play such a large role in oil markets? Is the amount of barrels they could put on the market? What caused them to be so influential in the global market for oil?
If you think about attack on a refinery complex in Saudi Arabia, it was Iran-backed Houthis from Yemen that sent missiles that took almost 5 million barrels per day of export capacity by blowing up these tanks in Saudi Arabia. The Straits of Hormuz going right by Iran. They threatened in the past to mine those. So if you actually got into a wartime scenario, it's substantial and it's material because so much of the carrier traffic goes right through there. So if you cut off the ability to trade through the Straits of Hormuz, that has a huge global repercussion.
Is this ever going to change, or just because of the geolocation of Iran, will they continue to always play a large strategic role in the global oil markets?
Well, it really is that. And it's the fact that the regime is fundamentally misaligned with Saudi Arabia, with Egypt, and with the West. So as long as it's viewed as a pariah and there's this even remote threat, and these are really low probability scenarios, because if it goes down that road, it would require greater global intervention to fix it. But high impact, low probability kind of scenarios are the things that people pay attention to, especially when trading and looking at financial market activity to go with it.
It's a pariah that you don't want to kick it because the bees might come out. It's just this weird, seems like it's a very delicate, just because the disadvantages of starting a conflict there that could have not just on the oil markets, but on the global economy, because the global economy, oil demand is set to achieve consecutive records in 2024 and 2025. The U.S. Energy Information Administration expects consecutive global oil supply records of a record of 102.4 million barrels per day in 2024 and 104.2 million barrels per day in 2025. What's driving that growth? And with this Iran issue, can the growth be met?
There are a couple of layers to the onion here. The growth is at two levels that are record levels. And it's notable that between their March and April assessment of global oil markets, that they increased retroactively the assessment from last year by 1%, or around 1 million barrels per day. So this is material. And that says that 2023 on average in their view is around 102 million barrels per day now, up from 101. This year it raises it to 102.9 now. So up from even what we had last month, which was 102.4. So adding 500,000 barrels per day this year. And then looking at next year, the exiting, it was at 103.7 or 8 million barrels per day. It's now up to 104.2, as you just mentioned. So these are substantial upgrades retroactively, carries in and affects the activity this and next year. But largely, if you look at the transaction and the way they changed their projections for this and next year, it's largely advancing growth that was expected to happen by 2025 into this year. So this is an interesting dichotomy, because we're looking at the headlines by the day and the concerns about economic growth. Will there be monetary policy changes, cuts in interest rates that might help cushion or stimulate activity along the way? This says that they are expecting, in the base case, more activity this year than what they had previously expected, and that it's consequently slower when you're getting into 2025 in their view.
Cuts, though, on the record are not going to happen. The CPI report came in, as Bloomberg said, hot. Is hot. Inflation sticky. Well, what happens if we don't get cuts this year? We're also running out of time for the 3 projected cuts. Maybe is there one possibly on the table? I think the Fed's going to have a very hard time of orchestrating a soft landing against the way things are looking.
I think your listeners will appreciate they've been following the outlook in our conversations over the last couple of years. I've consistently said I believe that price inflation will remain sticky. And there are a lot of reasons for that, from energy transition to commodities to the emphasis on things that with workforce and supply challenges at various points haven't been so easy to clear up. And I think there is a seasonal aspect to what's happening right now. The latest report for the U.S. came in at 3.5% year over year. It shows an escalation for 2 consecutive months. It's not the direction that the Fed really wants things to go. It's consistent, by the way, with increased spending, increased industrial activity. And it says the economy is strong. And it's strong not just on a U.S. basis, but on a global basis, has been upgraded by the IMF, as we were talking, the National Monetary Fund, as we were talking about in the last quarter or so. So this is a good news story and a good problem to have in the sense that global economic growth and U.S. economic growth are continuing. I do think because of the debt overhang, both at the household and corporate levels, and the New York Federal Reserve, their credit survey would say, as of fourth quarter, that's the latest now, $17.5 trillion worth of debt held by U.S. households. That's a record high. The delinquencies from auto loans to mortgages to credit cards that they picked up, but they're not at recessionary levels. They've just picked up. And that despite the fact that the delinquencies are up, auto repossession and evictions from homes, those things are not up. So people they're stressed and they're managing, but it's an issue. And if you have to spend more to pay for interest costs, you don't have as much discretionary income. So at some point, there has to be an issue where it's downward pressure on spending and discretionary income. Corporately, we've talked about $5.5 trillion worth of corporate debt that must be refinanced this year at rates that are roughly 3 times higher than they were at the end of 2021. The National Monetary Fund, the Bank for International Settlements, a lot of the official agencies have talked about the downside to global growth as a result of corporations hitting this wall. The Bank for International Settlements has an interesting research piece out showing that this basically could consume for especially small and medium-sized enterprises as much as 1/4 of their profits after taxes. So it is a big deal, and it is a serious headwind to continued growth, but we haven't hit the wall yet. You're still seeing economic activity go along at a pace, and price inflation consequently rising, where the Fed, as you said, doesn't necessarily have to cut a lot, but we need to see where they go, because I think that there's a very narrow bridge to walk to make sure they continue to have strong growth going forward and make sure it doesn't drop off. I'm sure they're watching this. I know they're watching this. And this is the kind of thing where they'll figure out what, if any, cuts will be necessary to make sure that they can sustain growth and not have a spiral that comes off.
Narrow bridge? It's a tightrope. There's no other way to say it than the Fed is walking a tightrope. These corporations are going to have to refinance their debt. Something's going to have to cut. Job loss. They're going to cut jobs. And consumers are strapped with credit card debt. They're strapped with mortgage debt. They're strapped with loan debt. Some are not very good interest rates. Then as things continue to deteriorate, and I'll use the term, do things break at that point? And then when things start to break, does the Fed or does the Fed just say, we got to get to that 2% mark? We're going to get to the 2% mark. Things are going to break. We're going to get there.
Well, it's pretty clear that they've backed off of the 2%. They're putting more weight on labor market activity right now. The fact that the labor market is still solid. So we added over 300,000 jobs last month. The unemployment rate sitting at 3.8% is historically still low. It's not saying that they need to rescue the labor market phase. So that's really, I think, the calculus that the Fed is going by. We'll see how markets respond.
If the Fed does not cut interest rates this year, how do the oil markets react?
We will get into, I think, the relationship, the inverse relationship that's historically gone between its interest rates as they affect the strength of the U.S. dollar and an inverse relationship with prices. And your biggest effect on the U.S. dollar is really the term is hot money chasing interest rates. So if I increase interest rates, I attract a lot of money into U.S. dollars from other currencies. The U.S. dollar appreciates. The U.S. dollar is still sitting basically close to its all-time high. It's not at the all-time high. A little air came out of it in the last quarter or so, but it's not big movement like you'd expect. If they start the path of rate cuts, you'd expect other currencies to appreciate around the world, people to move out of U.S. dollars. Oil becomes relatively more affordable. Emerging markets around the world will currency terms that stimulates demand. There's also a commodity trading aspect where I'm expecting interest rate cuts. I might actually hedge that by buying commodities, hence also potentially supporting oil and other commodity prices. And notably here, despite good economic news overall, we have gold basically at an all-time high, crypto at an all-time high. You have a lot of things that are sometimes bearish indicators that are at all-time highs. So it really is an interesting dichotomy.
There's a lot of things that don't make sense in this market. There's really no way to describe it. Overall, what role does Fed policy play in the oil and natural gas markets? You said that they yin and yang together, but what role do they really, truly play together?
I mean, monetary policy isn't meant to affect or manage commodity and oil prices so much. They are designed to really manage price inflation, where oil is still a big part of that. And the affordability of fuels, especially for transportation, for materials, increasingly important, agriculture as well. All of these things are tied together so that there is causality that goes through the greater system as a result of that. And they have to keep in mind on where that is. So we're talking about the interest rates. The other thing that's quietly been happening is during crisis time, we were talking about quantitative easing, expanding the balance sheet. It's just been the opposite, where long liquidity has been taken out of the market by the Fed and other central banks. That's the other thing that's quietly happening. That's part of why longer-term interest rates have been picking up, despite the fact that the near-term interest rates of basically the Fed funds future is sitting at 5.3% and hasn't really budged much. I think people expected many more cuts coming into this year. It's clear that's not happening. So as that happens, it's interesting, last week, it's the first time since really February that we've seen this premium for lower corporate credit quality start to go up above 8% if you were comparing Fed funds futures to high yield. And that for our sector matters because of corporate credit quality across independents, generally not always being investment grade. So you have to really pay attention to that. And a lot of smaller, again, companies that have to borrow are paying higher rates for it.
What impact do global central banks have on the oil market? Like the ECB, the Bank of Japan, what impact do they have on the oil markets when they decide to make a decision?
Well, think of the central banks as trying to coordinate. So globally, they're basically reacting to what the Fed is doing at this point. They're not really moving ahead of the curve. The issue has been that the Fed raised rates so quickly and so much that a lot of central banks are follow to the same extent. Hence, that opened a so-called carry trade, where I would borrow in yen and euro, translate the money into US dollars, invest in US treasuries, maybe hedge my foreign exchange risk, maybe not. But either way, I'm earning a real return and this is part of why the dollar's been so strong. It's part of why, as the Fed's expected to cut, the bear would come back out of the dollar.
There's interesting times that the euro is expected to go to $1.12 by the end of the year, further strengthening. Some estimates said to put as high as $1.14. We export 60% of natural gas to Europe. What impact is that going to have with a strengthening euro, declining dollar on the natural gas markets from an export perspective?
Keep in mind that these contracts are largely traded in US dollars like oil is. So if the dollar gets weaker, you're now making natural gas even more affordable. Given the fact that we've had 2 consecutive relatively warm winters, though, we're sitting here with pretty full storage in Europe and in the US, at least above the 5-year norm, but the range to look at. We're sitting here for the first quarter of the year with the lowest inflation-adjusted natural gas prices ever for the United States. This is historically low. So it actually should be stimulative to demand, and if monetary policy follows, that's pressure to help keep it in check.
Natural gas demand is growing. 24 and 25 projected hit record demand. Where's that demand coming from? Is that coming from data centers with the increase of AI, the GPUs, or what is driving the record demand for natural gas?
Like there are private projections that would say, I'm going to see huge increases in data center driven demand, AI driven demand for electricity in the United States, in Europe, and Western economies especially. And I think that's real. I think that's likely to stimulate natural gas demand. But on net, the EIA, the Energy Information Administration, and others still project that advanced economy natural gas demand is basically flat. In fact, backing some out of the power sector in the United States per EIA's projections of the next years, where you've got substantial growth, especially Asia Pacific. And it's not just India and China, by the way, on the coattails of that, but the rest of Asia Pacific emerging economies are really growing resoundingly in their demand for natural gas. They need it both for power, for industry as a process fuel. They need it during winter season for heating. They don't have a lot of domestic supplies of it. So the exports that are flowing globally, a lot of the growth in this will continue to go, not just to Europe for security purposes, but to Asia Pacific. The Middle East is also growing substantially, as is Latin America. So it truly is a global phenomenon. It's driving natural gas demand up.
The Asia one's interesting. Is that going into factories? You mentioned the heating for the households. I don't know why that be, but there's a big factory growth. There's a lot of factories popping up in Vietnam. There's Apple's now 10% of the iPhones, 1 in 7 now are manufactured in India. How large is the demand for natural gas in India?
I don't know the quantum exactly off the top of my head, but it's been next to China in the region, the second highest growth. And in terms of substantive growth, they've been a major consumer of liquefied natural gas cargoes coming in. They've contracted long-term for a lot of the supplies coming out of Australia and Papua New Guinea. It's continued to be strong. And again, without the domestic supply as much, they really do need and are reliant on the globalization of gas markets to bring that in. But from Bangladesh to Taiwan to Singapore. You've got the more developed economies, but from Bangladesh to Vietnam, you've got a lot of industrial economies that are growing. And in terms of the heating demand, just to reinforce that, whether it's Japan or South Korea, if you get in Northern Asia a cold winter, just like us, they bring in a lot more gas to feed that. So there is, especially in the developed economies across the region, a heavy reliance on natural gas to feed it.
Is that Texas natural gas? I asked that because Texas produced 27.8 billion cubic feet per day of dry natural gas last year. Is that gas is going? Is the Texas gas going to Asia Pacific?
Out of that 27.8, roughly half is maybe consumed in the state. And we are the largest industrial consumer of natural gas. We're the largest residential and commercial consumer of natural gas in the U.S., but we only need about half of what we produce. Now, out of the amount, the other half that's going externally, roughly half of that's going to Mexico by pipe, and then the other half's going by LNG. So you're seeing, and some of it's greater than half that's going, 60% is going by LNG. And out of that, 70% of that's recently been going to Europe. It used to be that most of that would have gone to Asia. So it really is Russia's war in Ukraine for the last couple of years. It's upended the regional balance of it. And over time, maybe that sorts itself out. Maybe not, at least as far as we see right now, Russian supplies being off the global market, largely for gas, with Nord Stream 1 and 2 pipelines having been out of service. You're really looking at continued needs. And a good demarcation of that in the last week or two, you've seen the headlines out of Germany where they're returning and expanding and now a natural gas plant. Now they've coupled this with a commitment that by 20 or 30 or 40, that they want to, in the long term, transition this to hydrogen. But make no doubt about it, the fact that a very industrial German economy is not competitive without having energy. And right now, a reliable, affordable source of energy is really important. Natural gas is the way they're going.
Natural gas is affordable. Hydrogen's expensive in California. It's over $200 to fill up your hydrogen car. I don't know what that would be to heat your house. Obviously, California has energy problems. There's a regulation coming down now where people are going to be taxed for collecting solar. Where does this policy end? Just because it seems to me that if these policies are forcing consumers in a recessionary environment with high interest rates to pay more, it's only going to accelerate a potential economic downturn, and the energy costs could be a driver of that, especially in California.
California, this is interesting because they have the highest rates in the nation. They're about 3 times higher than what Texas pays. And it has nationwide headlines, but over the last couple of years, in response to legislation there, they're implementing household income-based electricity charges. So imagine you spent $20,000 or $30,000 to get your household off of the grid and largely self-supply electricity for your needs, but you're still connected to the grid. Well, if you're a higher income household, you're going to be asked with the compounding of fees to pay upwards of $200 a month right now. This is happening. This has been implemented. Now, there's a proposal from the Public Utilities Commission in California to repeal it, but that hasn't happened yet. So far, the marching orders are by July that this goes in everywhere. So you are now, as a household, literally submitting your IRS tax return to your utility, $200 a month for the privilege of just being connected without any of your usage charges on top of it. So this is quite substantial. It does affect affordability even for $180,000 per year and higher is their higher income bracket, which in parts of California with the cost of living there is still maybe middle class for many other parts of the country.
I want to make sure I heard you right on this. You submit your tax return to your utility. Is that right?
Yeah. And over the last year, the CPUC held proceedings explicitly where the utilities, the major ones, PG&E, San Diego Gas and Electric, Southern California Edison, all 3 of them petitioned to say, I don't want to be the arbiter trying to determine somebody's outcome. Please use a third-party service. So then they hauled Equifax in, had them testify and do a trial run. And Equifax said, well, we could only be about 3/4 accurate in predicting a household's income based on all they were using. It's called the work number, but basically everybody's payrolls by companies, they track this. And to the extent that there is above board information that they can track from corporations and tax returns and things that are getting submitted, only with 3/4 accuracy could they predict it. So the CPUC mandated that the utilities expand the reporting mechanism they use for lower income programs. And I can send you a link to PG&E's website, but the first thing on there is send us your IRS 1040. And if that's not sufficient, big letters, we may ask for more. It's really astounding. No other place I've seen that's implemented charges based on electricity. And let's be really clear. The economic theory of what's efficient is you don't charge anybody more than the marginal cost to get them onto the network, because you want a positive network effect with all of them. And this is substantial. Some of the articles about it have talked about 1 in 4 California households being behind on their electricity bills, and basically it has system-wide costs. The root problem here is that the system-wide cost in California has gone up, prices have become unaffordable, and as a result, they're leaning back on the only constituency they've got that can afford it, which are higher income households. And it's just a cautionary tale. I mean, as in ERCOT, the Electricity Reliability Council of Texas, that covers over 90% of Texas electricity, we've implemented programs that, frankly, from a wholesale market perspective alone, cost almost $13 billion last year per the estimate for the independent market monitor for ERCOT. So billions, right? These are, and there's another ancillary service called a performance credit mechanism that they're potentially putting in place here this year or implementing. That's another $1 billion plus. And there have been headlines this week about questioning whether it's actually more than $1 billion. Use the Austin Powers Dr. Evil. It's not million, it's billions of dollars we're talking about. This is big money.
What's next? Go to what's next, but then the first I go to, I'm going to put on my economics app, cybersecurity insurance. That's expensive. Then you have to get D&O insurance. You have to get liability insurance. And now that's going to be the next tax that's passed along because you have to cover the insurance costs. What happens when there's a data breach? That's going to open a whole can of worms. And a lot of the companies in the Valley and San Francisco, Northern California, very highly paid executives, they're mostly paid in stock-based compensation. They're not paid in cash. So now do you have to submit your stock-based compensation as well as your cash-based compensation to pay this? Then if you look at it from an energy perspective, why would anybody want to put solar? Why would anybody want to try and do sustainability, go off the grid? And on the backside of that, is this going to be a tax on the individuals that bought an electric vehicle? Now they're going to have to pay even more to charge it? And does that lead to a shift back to internal combustion engines that use a little thing that Californians consider dirty, gas? That's a derivative of oil? Is that where this is going to go?
Well, California's mandates basically phase out internal combustion in the next decade or so. So that's going to be an interesting challenge. You raise an interesting point in questioning whether you've got any incentive to invest in household efficiency, in solar panels to get off the grid if you're still going to have to pay for the grid connection. That is interesting. I think the idea of raising these fixed charges is that they might be able to lower the usage charges so they're not 3 times greater than the rest of the country. So maybe the usage component becomes relatively more affordable, but net, the higher income household is basically the tax a lot there.
You already have the second highest tax rate in the country. You might as well pass New York and make it the highest tax rate. This is just astronomical, but you've got a great governor, Governor Abbott. They're moving to Texas. Tesla moved to Texas, and I saw Governor Abbott put out a tweet. Number 1 employer in Austin is Tesla. Over 22,000 individuals work for Tesla in Austin. Oracle moved their headquarters there. The one that I was talking to an economist the other day in California, I said, when do they wake up and realize? And he said, they're not. And I said, okay, let me ask you this scenario. What happens when Wells Fargo and Visa decide to move to Dallas? Oh, that's going to wake somebody up. Bring all those jobs to Texas. It's the Texas economic engine that's working. And Texas accounted for 42.7% of all U.S. oil production in 2023. Its highest level since 2020. You're creating jobs. You're creating oil, and not just jobs in tech. You're also creating jobs in the oil industry. You're also one of the largest employers in the trucking and logistics industries. Do you see the trend of Texas oil demand continuing to grow?
We don't predict it with precision, but yes, because the Permian Basin in particular is your most prolific and growing source of oil supply in the United States. It really is the hotbed of activity and innovation for the industry. So it's very likely that, especially as the Colorados of the world continue to struggle with whether they even want a fossil fuel energy industry there, you're continuing to see Texas. And I was in Houston yesterday listening to Governor Abbott. He was at the conference where I was participating, and he basically said, we move at the speed of business. We respond to business. They are very proud of the policies put in place to attract all the corporate headquarters that you mentioned, and it's growing. And you've got roughly 1,500 people a day moving to Texas. So this is a big deal because demographically, economically, the stronger getting stronger here. And these policies really do reward good policies and good behavior.
Because the economy is strengthening. The Texas economy is strengthening, and it's a diversified economy. Yes. You're producing 42.7% of all U.S. oil. How much of that oil is exported overseas?
The short answer in recent months, and very close to the average for last year, is almost 4 million barrels per day of just crude oil. But there's almost that again of different other products. So refined products and natural gas liquids. And when you look at global oil markets, which is really the lens through which we're trying to assess all of this, the totality of all the liquid supplies matter, whether they're finished products or not. A barrel's a barrel. and barrels are relatively fungible. So this makes talking basically almost 8 million barrels per day going out to global markets. Texas imports about 1 million barrels per day, a little over, of crude and other liquids, but they're of different qualities. So for example, you might take heavier oil from Canada, process it. These quality differences come into play. But net, it's at least 7 million barrels per day. You account for all.
Is the United States once again net exporting oil again to the world?
We have been, and it's interesting because it's swung all over the place. About 3 weeks ago, we had net exports of 4.2 million barrels per day of total petroleum. And that was the second highest weekly net export total on record ever. It was amazing. But in today's release coming out this morning, it's only down to 800,000 barrels per day. So you really do, you've got holiday seasonality with Easter, Passover. You've got a lot of things that vary as you're transitioning now towards summer driving season with some of the products and the way they shift. So there is a seasonality to this. You smooth it out. And in general, we've been going net exports of a little over 2 million barrels per day, kind of chugging on. But we need to watch it because if those things drop off substantially, then that could be a sign of where global markets are going, and the potential slowing and concerns. If they remain super hot, it's just the opposite.
That's very interesting. So low export, that's going to mean a weak global economy, and a high export, a strong global economy?
High export are going to tell you that there's a big global pull for energy, especially oil. And as the economy goes, this is that bedrock, right? As the economy goes, so goes your demand for both oil and natural gas and total energy, because you don't get any form of economic growth without having energy in some way, shape, or form to supply it. It could be electricity, but for trailing gas that are heating.
Is oil and gas the backbone economy?
Absolutely. Over 90% of your energy for transportation stems directly from oil. In the power sector, it might be close to 30% of its natural gas. On a global basis here in Texas, depending upon the time, we're talking 40 and 50% is natural gas. So it really is critical both to the state economy, to the U.S. economy. It's huge pull for exports. We're continuing to see, not just because of Russia's war in Ukraine, but natural gas exports that could grow the export capacity of this. We've got the debate federally about the pause on potential prospective export approvals, which in our view is really fundamentally bad economic policy. It's bad for investment. And frankly, it's bad for their own environmental goals of trying to supplant coal and lower emissions globally. On all fronts, growing natural gas demand, growing oil demand, it's both good for the country and for the world in terms of human and economic development and making environmental progress. We're responsible ways here at home.
I'm going to ask you the contrarian question because I'd love to get your opinion on this, because certain individuals want to remove all traces of. If we removed oil from the global economy, where are we? Do we even have a global economy if oil was removed?
No, you really don't. And let's be clear. I mean, despite people trying to phase out and incentivize the alternatives, and whether you look at Alex Epstein, his book, Fossil Future, talk about Backlash Schneel and his book on how the world really works, there's really thoughtful analysis that takes apart transportation systems, agriculture. Think of agriculture where 20 to 30% of your food costs off the top is just energy related. And most of that is oil and natural gas between transportation, fertilizer, feed, heating through the winter. What keeps your turkeys alive in Minnesota or Mel being based there, right? You've got a lot of things that really say you need to have oil and gas. And from a productivity standpoint, how it is that the world feeds 8 billion people on the planet with the resources that we've got has only been made possible by productivity. So if you peel back the layers on, and both of these authors actually, Epstein and Schneel both do, that talk about the productivity per gallon of diesel, for example, in transportation, for feed, for fertilizers, all of the progress that substantially made it so that we have the global food system that we do. Without modern fertilizers that are mainly nitrogen-based, natural gas-based, you wouldn't have the productivity that you do. So the global system, the global economy, the world depends on having these resources.
This book was great. How the World Really Works. Bill Gates actually recommended on Gates Notes. It was like a textbook. You're back in college, the way it was written, but it was really informative. It was a really balanced approach to where we are from a global economy and the role that energy plays in the global economy. The economy of the world are interconnected. And you want to use the term oil. Oil is the pre-broadband. It's that critical to the global economy. Here's an interesting thing to ask you. To generate $1,000 of GDP in 2023, the United States economy required about 13 gallons of oil, compared with 14 gallons in China and goods. How and why?
Well, it's interesting. These are calculations that I've done based on the official data sources, but when you translate an economy into US dollars, you can either do it with or without adjustments for the purchasing power of each currency. And if we're just straight up using the actual exchange rates, this is what you get. And it's interesting because there used to be a much larger gap between the US and emerging markets, especially China. And the narrative was that China was growing really fast and its oil intensity was so high. So therefore, you get this unsustainable amount of oil demand and energy demand as they grew. But a decade later, here we are almost at parity in terms of the relative. This isn't technical efficiency, it's economic efficiency because it's a combination of both the technical basis by which the economy translates this into value, as well as just the growth of the economy itself. So if you're thinking of it as division in the numerator or the economy and the denominator, the economy has continued to grow 5 to 6, on the lower end this year. As that grows, though, it's growing a lot faster than the oil intensity of the economy and energy intensity of the economies come down. The fact that emerging markets, they're higher, but they're not twice as high as they used to be. This says that the world is converging. It's what you'd expect. It says that the fusion of technology works and that energy efficiency is a real phenomenon that as you continue to grow the economy, relatively more efficient use of it says that other things being equal, you're getting human economic development that's sustained because. So you really do have to think of that nexus of making human and economic development over time using energy in these ways.
Energy efficiency drives economies and drives businesses. This goes back to the Jack Welch days at GE. Look at all the energy efficiency that they were able to unlock. And their energy business did really, really well there. And China wants efficiencies. That's the way you see the public statements from President Xi of China. They're trying to unlock efficiencies any which way they can so they can sustain their economy. India's trying to do it. Our economy is trying to do it. We're all based on efficiencies. What is the largest global oil demand?
As individual economies, it probably is still China, but India and developing Asia are right there with it. And keep in mind, China, despite all of the push for electrification, for minerals, for all of that, it's an all of the above strategy. So they are still now the largest importer of oil in the world, 12 to 13 million barrels per day and growing. So this just says as the economy continues to grow globally, this is a global issue. It really is all intertwined. So we have to look at it in a global perspective when we try to have U.S. policies that asymmetrically just say, okay, we're going to do this. Well, we're going to do this, but to what end? When you're talking about subsidies to kickstart things, you have to think, can you scale up the subsidy to a societal level? That's kind of what we're doing with the Inflation Reduction Act. And keep in mind that in the way that even under the Inflation Reduction Act of 2020, the Congressional Budget Office only scores these bills for 10 years, and these credits ostensibly go in perpetuity. So that's not paid for. And that's the kind of thing that makes it vulnerable in the longer term to really think about from at a time when we're running a primary government expenditure deficit in the U.S. of over 30% of GDP. In terms of affordability, debt sustainability, not having your debt grow faster than your economy, these are all the kind of macros in the next decade or so.
The United States, that's a problem. Jamie Dimon, his annual shareholder letter, he called it out point blank. It's a problem that we have to address. I don't see, I'll be nice, next approach to the budget. I don't see it happening. I had dinner with a politician recently. He was a former Speaker of the United States House. I'll leave it who he was. Very nice, interesting conversation. And I said to the former speaker, I said, sir, when is common sense going to take place? He stands up and he gives me a hug. He said, that's the kind of thinking we need. And he was telling me stories when he was trying to balance the budget with Newt and all these various different stories and where they wanted common sense, get the noise, the chat, what's right for the country, put country first. But if we don't get there, what's going to happen? Does the price of energy go up long term as the debt keeps increasing? Or what impact on the energy markets will this have with an increasing debt load of the United States?
So look, it's not the mainstream view, but there are some that say regardless of who wins the November U.S. presidential election, that either party would expand spending in ways that might be deemed irresponsibly unsustainable. And the financial market reaction to that, and this is where U.S. debt gets downgraded, the financial market reaction to that could be, and that's where you get into a scenario that people are most concerned about being a thing that, but it is the traditional phrases, we're still a pretty source in the glue factory. Right now, the U.S. is continuing, and these things are good until they aren't good. And that's why politically it's been really the third rail to try to fix it, because you unilaterally have to go out and take entitlements or benefits away from people, spend less. Keep in mind, going back to our early conversation even about the job situation, a lot of the job growth this year, and you mentioned it, tech companies, as they're becoming more accountable and needing to pay attention to profits, they are cutting back. They've reduced a lot of jobs this year, larger companies in general. And a lot of the job growth has come from some service industries and government. So these aren't the high value add jobs. It's been a lot of government spending that's helped hold that together. And in the aggregate, the macro picture looks okay. But the balance of how it's growing and where it's growing, how sustainable that is, and what that means as we get into next year, there are lots of things to really contemplate.
It's unfortunate. Layoffs are only going to accelerate. Apple laid off the Project Titan, the car team, recently. There was an analyst report, I believe it was RBC or Wells Fargo, I'm unsure of the bank. It said Tim Cook found his discipline again. More layoffs to come at Apple as Apple tries to right the ship. Those are high-paying jobs at the layoffs. You look at the ones at Meta. We can go down the line of tech companies. Those are high-paying jobs. We're going to have a very, very big problem if the Fed can't land this ship. You mentioned 12 to 13 million barrels per day that China's importing oil. Where is that coming from? Because I read a report today in Bloomberg where somehow Russia's cut off from SWIFT, but yet they're still trading oil at record numbers. Is Russian oil making its way into China, or where are those 12 to 13 million barrels a day coming from?
Well, I mean, your number one source would be Saudi Arabia and OPEC, but Russia absolutely is supplying. And I think we've talked about the statistic in the past where Javier Blas of Bloomberg has highlighted that Malaysian exports of crude oil to China are roughly 3 times their productive capacity of crude oil. You've got these basically at-sea markets where things get loaded, offloaded, blended, and Russia's been pretty masterful at continuing to find that. Now, there have been headlines saying that some of the secondary enforcement of international banking and other regulations has started to bite Russia a little bit, but usually what that means is you just have to go to different buyers that maybe apply a slightly different discount, a deeper discount to continue to place those barrels into second, tertiary refiners in each economy. But it's happening, and I have no doubt in the Energy Information Administration, their projections of global oil. This is interesting because they had said that there would be very little, if any, reduction of oil supply coming from Russia this and next year. In the March outlook, they had actually scaled it back to be a few 100,000 barrels per day. But now, as of the April outlook, they're basically back to steady as it goes for Russia. So this says that Russia's going to continue to skirt those regulations just to go along with Saudi Arabia for OPEC plus cut.
You can't stem off the fuel. Mark Rich, all the stories. The King of Oil was a really interesting book about what they did with the ships. The oil kept moving out of Iran. It kept moving. The oil is always going to continue to flow. It's always going to continue to be a part of the global economy. There's broadband connectivity and there's oil. Both are critical components of the global economy that lead to economic. Dean, in your opinion, what are the key things to watch in the oil markets over the next quarter?
We've talked about a lot of them. We really do need to read the tea leaves on the economy. And again, we've got a weekly chart book in addition to a monthly energy economics outlook and a quarterly view with a more polished outlook across the economy, oil and gas markets. And we look carefully at the indicators in this weekly chart book, and they don't show a huge drop off. They show a continued growth actually through the first quarter, momentum going into second quarter here. And that suggests that energy continues to grow in demand as the economy grows. And right now, again, the base case is we're chugging along here, and we need to continue to monitor for any turns. Geopolitical uncertainties, I think everybody pays attention to it, but they haven't meaningfully derailed things. And think about it in terms of the growth quantum. I've given this comparison in the past, but the 2 to 1 thing. If the economy grows roughly 3% on a global basis, divide by 2, and that means you need 1.5 million barrels per day more oil this year than last year. Now, the economy is growing closer to 2.7%, so it's a hair under that. But EIA and IEA, the International Energy Agency, the Energy Information Administration, they both have growth this year that's 1.2 to 1.4 million barrels per day. Even if you cut substantially off global growth, you still need more oil, as long as the economy is growing and not in some abject collapse as it was back in 2020 with the pandemic. So this says that other things being equal, if the economy is growing, I'm going to need more energy. We continue to see that. It could be stronger or weaker. It'll affect the price environment, but from a demand perspective, there's no question the need is there.
Growing economies need oil. We'll summarize it that way. And for your turn, Dean, as we look to wrap up this next quarter when we have you back on in June, what would you like our listeners and viewers to take away with them today?
I hope these conversations are helpful in terms of educating on the things that we really look at. I hope it's leading to a dialogue about what the things, there's no free lunch, so to speak. So when we brought up the California electricity issue, when you see policies locally or US wide that basically seem to raise costs and you wonder where the money's coming from, well, ultimately there is a bill to pay for these things. And Whether it's a federal bill or a state bill or a local bill, they're getting paid, and they're getting paid sometimes through some really perverse policies, like we're seeing with these income-based electricity charges in California. That, the cautionary tale, understanding where this can go and what it really means to you as a consumer, understanding the patterns that go. Please refer listeners to techfoga.org, txoga.org, our weekly level. Feel free to reach out on LinkedIn. I love a dialogue on these issues.
I enjoy having you here every quarter. Understanding the energy markets is key to understanding the global economy. The future is bright, the future autonomous, the future is a strong and vibrant energy market. Dean, thank you so much for coming on the road to autonomy economy today.
Thanks so much, Grayson. It's always a great conversation. I really enjoy it.